Do you think it's possible for Tesla to reach $400 this summer? Currently sitting at $193.17 per share, a $400 price tag is more than twice what Tesla stock costs right now. That said, would that even be possible? Well, you all know that despite the volatility in the stock market, a lot of people remain bullish on Tesla. In fact, in a recent CNBC Lightning Round, where Mad Money host Jim Cramer rings the Lightning Round bell and gives his answers to callers' stock questions at rapid speed, Cramer said, "I would say absolutely, yes, I would add Tesla." This is in response to a question if Tesla is a buy. However, it is also worth noting that when Tesla previously announced that it would be raising prices for its top models just a day after the company's stock took a dip following the SpaceX rocket explosion, Jim Cramer gave an emotional response when asked about his thoughts on Elon Musk's energy and automotive company. "He raises prices, he lowers prices. I'm at Dollar Tree with this guy now," Cramer said. "It's like Uber meets Dollar Tree and we come up with Tesla." Cramer had been fairly supportive of Musk's Tesla in the past, and he acknowledged that his being critical of the company is particularly telling. "He's got to calm down," Cramer said. "We love the guy, but he's got to calm down." The Mad Money host also criticized Tesla's highly anticipated Cybertruck. "I'm calling it a toy for Elon Musk fanboys," Cramer said. "This thing is ugly, I'm sorry, and I love Tesla, by the way." Cramer added that he doesn't think customers will get much value from the truck, saying it'll cost too much and will have to carry a huge battery. The Cybertruck was first announced in 2019 and has over 1.5 million reservations. Production for the truck is still scheduled to begin later this year in what's expected to be one of the most highly anticipated car launches ever. Still, Cramer appears to remain bullish on Tesla despite his reservations about its CEO Elon Musk. So, is Tesla stock really a buy like Cramer said? According to a recent Barron article, these days signal a tough time for the EV company as demand slows and costs rise. More than that, Elon Musk is distracted and a distraction. But because of this, it's time to buy the stock. It is no secret that Tesla is kind of a mess right now, and signs point to a bumpy ride ahead. Well, this year at least. Delivery growth has slowed below the company's own goal, while production has exceeded deliveries by an increasing amount in recent quarters, and prices are getting cut, all signs of waning demand. Musk's behavior since taking over Twitter has also raised questions about whether shoppers will buy other electric vehicles now that they are available. And if that isn't enough, the US could face a recession by the end of the year. Still, some say that while those may be overwhelming reasons not to invest in the EV company stock today, you should ignore them. Yes, ignore all those, but instead focus on what Tesla is, the leading EV manufacturer in the world, and one that has a decade-plus head start on other automakers as well. It is important to note that Tesla can produce cars at a much lower cost than its competitors, giving it room to cut prices to stoke demand in a way others can't. Tesla stock is a risky bet, to be sure, but with shares off 72% from their all-time high to $113.06 and nearly 21 times 12-month forward earnings, down from 201 times 2 years ago, the opportunity is too good to pass up. Moreover, Tesla can sacrifice profitability if it means undercutting competitors on price. Arguably, if Tesla cuts price, it's a worse situation for their competitors, given many struggled to make any profit, explains RBC Capital Markets analyst Joseph Spack. What's more, Tesla is one of only 2 automakers that makes a profit off EVs. The other is BYD. Everyone else is losing money, even General Motors, which sells a $110,000 Hummer and has targeted EV profitability by 2025. Others, like Toyota Motor, appear to be getting cold feet in the rush to meet EV demand that may not materialize. Most EV startups, including Rivian Automotive and Lucid Group, are far from profitable and don't have the scale to compete. It's a precarious position to be in at a time when investors are demanding profitable growth and not just growth. In September of last year, analysts said that Tesla stock could hit $400 over the next 12 months. That said, the probability of Tesla stock soaring to $400 can happen until September of this year. Looking ahead to next year, we now forecast Tesla could lift gross margin by another 300 BPS year over year, thanks to positive mix shift toward lower COGS production facilities and benefit from IRA's battery production credits in the US. Deutsche Bank's Emmanuel Rosner explained at the time. Starting from a base COGS cost of goods sold per vehicle of $36,000 in 2021, Rosner assumed that by expanding the manufacturing footprint to lower COGS regions and facilities, Tesla could generate an average cost reduction of $2,400 per vehicle or 6.5%. Additionally, U.S. battery production credits in Fremont and Texas could save around another $800 per vehicle when averaged out on a worldwide basis. Put together, the potential cost reduction of $3,200 per vehicle could amount to an improvement of 5.5% of the ASP, average selling price. Although keeping a lid on expectations, Rosner conservatively only boost 2023 gross margins by 200 BPS from 29.5 to 31.5%, suggesting a 300 BPS improvement from 2022 levels. That results in adjusted EPS rising from $6.60 to $7.15, some way above consensus at $5.82. In light of this, Rosner raised his 12-month price target on Tesla to $400 from $375 while reiterating his buy rating. However, Ophir Kruvi, product manager at Jika.io, pointed out that 2022 was a difficult year for Tesla since it was well acknowledged that the firm was overpriced and everyone was waiting for the bubble to burst. Even yet, a subsequent recession forced the company to slash prices by up to a fifth in order to stimulate demand, noting that Tesla's current valuation is still a little bit overvalued, with a fair value around $80 to $95. Tesla is nearing the end of constructing the Tesla Megapack's Power, Europe's biggest battery energy storage system. Kruvi said that this is expected to multiply Tesla's current income from energy storage by a factor of 10, resulting in an additional $10 to $15 billion in revenue for the company by 2023. Still, he said, $400 is a price tag that is more relevant for 2025 to 2026 than 2023. While things are looking positive for the company overall, it's unlikely that 2023 is the year that takes Tesla to new heights. The price target for 2023, in my opinion, is more like $130 to $140. Meanwhile, Orange Charger head of business development Joseph Nagel suggested that Tesla had been overvalued for a while, and the market has now reacted to reflect this change. At this time, they are being evaluated strictly as a car company, although he stresses they are much more than that. He said, $400 a share is highly unlikely this year. However, if they can get back to the $35K entry-level price point that's been moving away for some time now, things might change. At this point, it'll come down to orders and deliveries, just like every other OEM. If they can get closer to that lower price point, they'll likely put in a number of new customers and see the needle start moving in a better direction. Meanwhile, Adam Pippington, chief financial officer at Freedom Dividend, said Tesla stock can reach $400 in 2023. The experienced financial expert with decades in the industry notes that in the coming years, the firm is projected to increase its production and deliveries, and Wall Street may become more bullish on the stock. Pippington stated, "There are a few key factors that would need to happen in order for Tesla stock price to reach $400 in 2023. These include continued strong production and delivery growth, expanding into new markets, a successful launch of the Model Y, and improving margins." In light of this, if you're considering investing in Tesla or another company you're passionate about getting behind, there are a few considerations you should make. First, never invest more than you're comfortable with. Knowing how much to invest will ultimately depend on how much you're comfortable tying up in the market and how much you're okay with losing if things don't work out in your favor. Also, don't try to use past performance to dictate future earnings. Just because an investment is doing well or has done well in the past doesn't mean that you can stand to win big in the future. When choosing a stock to invest in, you should do your research and look into a company's price history, revenue, and projections. But keep in mind that your decision about what to invest in and how much should be based on your risk tolerance, time horizon, and investment goals. Most importantly, you shouldn't tie up all of your money in one company's stock. There are ways to gain exposure to investments in several younger companies without putting all of your money behind a certain one. A globally diversified portfolio of index funds will own some young companies by default, so by that criteria, everyone should own some younger companies, says Paul Peeler, a financial advisor at Integrated Financial Group. But very few people should have a substantial portion of their investment mix tied up in direct shares of young companies. Make sure to subscribe for more Tesla stock updates.